Hey everybody, welcome back to the channel. Palantir shares are down 9% on the day in about 3 hours since the market opened because of typical Wall Street games. If you've been an investor, been in the markets for a while, this is something you've probably seen happen many times. I've been, seriously investing for the past 2 years, even though I started in 2019, but from 2019 to 2021, I really had no idea what I was doing. And this stuff, every time it happens, it's just interesting to see. Every single time it happens, you're like, oh my goodness, it's happening again. And it's happening right in front of us. And when it's happening, it's really cool to kind of see why it's happening and what the implications are for why it's happening. Palantir is down 9% on the day, down from $16.35 yesterday to $14.80 at the time of recording this, around 12:30 p.m. Eastern Standard Time. 9.34%. Why are they down? Because Morgan Stanley released a report, and that report is all about why Palantir should not be worth $14, should not be worth $16, should definitely not be worth $25, as Dan Ives says, but rather should be worth $9. They are upgrading their price target from $8 to $9, and they wrote 21 pages on why the 50% or 45% overvaluation from $9 deserves to correct, which means they expect a 45% downside to Palantir. Now, this is going to be a long video. I'm going to need you for about 20 minutes. I'll try to get you out of here in about 20 minutes, but I want to break down the report. I have the whole 21-page report. If you want the report, DM me on Twitter. AdamIsInvesting. Link is in the description, and I will send you the report. But there were a couple of things that I saw in the report that made sense to me. A couple of things that really didn't make sense in the overall sort of argument that they were trying to make. And then a couple things that are like iffy kind of here and there. So we're going to go through the report, and then we're going to go through my overall response to the report and why I think at the end of the day, Morgan Stanley is just trying to create another buying opportunity for them. They are trying to manufacture the dip, and they have successfully done that when you put out 21 pages on August 31st, 2023 at 4:01 a.m., right when the markets open, or at least the pre-markets, for Palantir to drop 9%. Let's get into it. So Morgan Stanley starts off the report by saying the POC excitement versus the market reality is a mismatch. Essentially saying the POC, which is the proof of concept, what they mean by that is the AIP product that Palantir is kind of betting the future on, is a proof of concept. It's not a real thing that's generating real revenue. So there should be a different market reality around Palantir versus what the market is giving in terms of the premium. So there's a couple of reasons why they are bearish, and we're going to go through all those, and then we're going to talk about kind of some of the numbers behind this. So they say the valuation is overly reflective of Palantir's AI promise, but fundamentals remain mismatched. Over the past 8 months, Palantir's valuation has expanded more than 180% as the company has made a timely pivot in its product strategy to emphasize a new AIP platform. Going forward, we believe the onus for stock outperformance shifts towards investors now looking for tangible revenue contribution from these generative AI initiatives in the months ahead, an expectation which me disappointed given Palantir's lack of a monetization strategy for AIP. So, if you want to just get the crux of the report, that is their entire thesis. Their core point is that Palantir shares are up. Revenue growth last quarter was 13%. We're not seeing any tangible AIP monetization strategies. So why is the market giving them this pretty rich premium in terms of stock performance, but the stock is not matching up, or the company's not matching up to be able to show the revenue growth to justify that stock performance because AIP has not been monetized yet? So their core 3 bear cases are expected delays in AIP revenue contribution, given the management commentary that the company hasn't been able to figure out how to monetize it. I'll have a response to that in a second, but I understand why Morgan Stanley is afraid of the fact that they're not able to monetize. And that CARP, has said we really don't know, but we'll figure it out. Second is the risk that the government business may not be able to offset a top line deacceleration. Essentially, we're not going to go through it in the report, but they talk about how there's more competitors in the governmental space. So even though Palantir grew governmental revenue 15% year over year last quarter at $300 million out of $533 million, they still feel there's more competition coming through the governmental angle. Players like C3 AI, Oracle, etc., which means it's going to be less likely that Palantir grabs all those deals. And then finally, they say a difficult setup into the second half of the year as revenue guidance already implies an acceleration in estimated organic revenue growth, which sets a higher bar for positive estimate revision necessary to justify the valuation. This basically means, look, they're guiding 16% year-over-year revenue growth. We don't really see any AIP monetization. They're already going to have a hard time meeting that 16% number. So if you're talking about Palantir growing towards the end of 2023, that's just not going to happen because first, it's kind of up in the air if they're going to be able to meet their own revenue guidance. And then second of all, even if they do, there's definitely not going to be any AIP monetization. So it's hard to justify a overvaluation on the upside of that guidance because it's just likely not going to happen given there is no AIP monetization so far. Finally, they say, while investors are near-term focused on a favorable event path, which management has been talking about over several quarters, including GAAP profitability, S&P 500 eligibility, and the large UK governmental contracts, they're talking about the NHS deal that's going to be decided by September 28th. We expect these could present potential sell the news events as investor focus shifts back to fundamentals as we surpass these events. Essentially, the two biggest catalysts left for the year, which is the S&P potential inclusion, which will probably happen next year, but we need to be GAAP profitable for next quarter in order to ensure it, is a major catalyst, right? Because investors want to see, hey, can you get into the S&P 500? That means more institutional investors will have to have exposure to your stock. That matters. And second, the NHS contract, which is going to be worth upwards of $500 million, and it's going to set Palantir up as one of the premier organizations in the world if you're managing an entire country's healthcare on your platform. Those two catalysts that I think are important. I don't know how they affect the stock, but I do think they're important long-term for the company, which is the thing I really care about the most. Morgan Stanley's argument is like, look, that's cool, but that's not going to justify the lack of revenue growth. That's not going to justify the multiple that's currently being put on the stock. And that's definitely just going to be a sell the news event. That's not going to be something that's going to bake in all this new valuation into the stock. And that's what they meant by second half guidance for the rest of the year. It's going to be hard to surpass or even meet because all these things, all these catalysts that, investors are excited about when it comes to Palantir, even if they happen, how monumental is it in comparison to actually monetizing AIP and getting back to that 30% revenue growth? And so their argument is essentially, if that's not going to happen, then we're not going to be excited for Palantir. Now, they do make a point here in the report, where could we be wrong? They say, we see three primary areas of potential upside risk. Number one, a pivot in AIP monetization timelines could pull forward pricing impacts, or investors could prove more patient in awaiting this progress, which would likely limit downside near term. So I don't think AIP is going to monetize until probably second half of 2024, if that. And so if that happens, in the first quarter of 2024, then that would be a big deal. And so those are areas where we could see more revenue growth, but we have to see that actually happen. S&P 500 inclusion could drive more institutional interest in Palantir, but we expect that at the current valuations levels, this risk is limited as the incremental active buyer is likely to be more valuation sensitive. And finally, large governmental contracts such as the larger NHS and several US DoD awards tend to have lengthier procurement processes with limited visibility, and as such could provide an upside risk should larger contracts materialize in revenue. The 118 million Palantir got in June, they got 3 sole sourced contracts from the Space Systems Command and a couple of other agencies I'm forgetting on the top of my head. No one expected that 118 million. I mean, that news just came out of nowhere, right? And it didn't move the stock too much here or there because I think the stock was already trading at around 15, 16 at that time. But still, Morgan Stanley is acknowledging like, yeah, there could be some governmental contracts that come out of nowhere because it's hard to see if they're coming down the pipeline. And if Palantir is able to get those, obviously that is going to be very good for the company long term. Now, here's what I want to show in the context of their bull, bear, and base case. And then we're going to get to my response on the entire report. So if all you wanted to know is why is the stock down 9%, it's because Morgan Stanley says AIP revenue growth is not coming. And because AIP revenue growth is not coming anytime soon, the premium that the stock has baked into this idea that there's going to be all these enterprises spending on AI and Palantir is going to be one of the key companies being able to grab up all that market share is not justified because obviously the revenue growth is not there. So that is the core thesis that Morgan Stanley put out for these 21 pages. Now, I thought this was really interesting. Bear case, base case, bull case. Bear case is $4, 24x 2024 EPS of 17 cents. Base case 22x 2028 estimated free cash flow of 1.6 billion. Their bull case is 28x the 2028 estimated free cash flow of 3.1 billion. What's really interesting here is that in the bull case, they have a customer count growing at 23% to about 1,400 by 2028, with the average revenue per customer at 7 million and revenue growth at 30%. Over the next 5 years to have 9.1 billion by 2028. Base case, they have revenue growth at 19% over the next 5 years, 5.3 billion in 2028. Average revenue per customer at 4.4 million and customer count growing at 21% to 1,285 by 2028. And their bear case is only a customer count growth of 20%, 1,207 customers by 2028. Average revenue of customer declines to 3.2 million. Right now, it's exactly at 3.2 million. And revenue growth at 11% CAGR over the next 5 years to 3.6 billion by 2028. Right now, we're going to do a revenue growth of 16% in this year. And our customer count has been pretty horrible in terms of its growth. It finally picked up last quarter. We got 31 customers growing at 8%. Last quarter, it was about 6.5%. And it was declining for the past 4 quarters. So we finally got a reacceleration to the upside in terms of growth for customer count. But these are their numbers. Essentially, to get to $20 in their bull case, we would have to do a 30% CAGR, which we're nowhere near. We would have to have a customer base growth at 23%, which we are nowhere near. And average revenue per customer has to go to 7 million, which AIP hopefully is going to be able to do. But right now we're at about 3.2 million. So Morgan Stanley is obviously, I mean, if you're looking at that, their bull case, $20. And that's if you can grow your revenues 30% over the next 5 years. You would argue that they're pretty bearish, the company, right? Because, like, look, even if all the numbers make sense as you go super deep into it and say that theoretically, even if Palantir is growing 30% year over year, $20 is like numerically makes sense. We all know if they're growing 30% year over year, they're not going to be worth $20. There's too much retail hype. There's too many institutional investors that are interested in the stock. I was emailing a money manager this morning. We were talking about Palantir. He's in Texas. He manages about 30 million bucks. I mean, like, there are a lot of people that are interested in Palantir. There is a lot of potential growth in so many different verticals and industries. So the idea that we actually grow at 30% year over year for the next 5 years and the stock stays stuck at 20 bucks, like, no, there's going to be way too much interest in the company, even if that is an overvaluation, which we've seen with the biggest companies in the world. They are overvalued for a period of time until they go into the valuation. But if you miss out on that overvaluation, you miss the entire story, right? Because there's just too much interest over the potential growth while the company is in that stage. So you would argue, after seeing this report, a bull case of 20 bucks with those growth metrics and all of the arguments for why AIP revenue is not going to happen would mean that Morgan Stanley doesn't like Palantir, that they're bearish, the company, right? Well, this is where we get to the part of the video where I respond to this report. This is a picture I tweeted today. Morgan Stanley reports a 56% increase in their ownership of Palantir Technologies on August 14th, 2023. So this could have changed since August 14th, 2023, but, you know, given August 14th was about 2 weeks ago, I don't know how much it changed. Morgan Stanley filed a 13F form disclosing ownership of 17.9 million shares of Palantir, valued at $275 million. That is $250 million they have in Palantir. They previously had 11 million shares on May 15th. So from May 15th to August 14th, they loaded up on about 6 million shares. Now, why did they load up on all those shares and at 56% more than they previously had and say that the stock is overvalued? Why haven't they just sold out of all their shares, right? If the stock is overvalued, sell it at 16 and take all those $275 million and then buy it back at $9. It's because they probably know the stock is not going all the way down to $9, given there's a couple of reasons I'm going to highlight in this Twitter post, and they're trying to generate a dip. I'm not saying this is a dip you have to buy. I'm not saying Palantir is undervalued. There's a lot of good arguments for why Palantir is still overvalued, given these valuation metrics that currently, given the revenue growth, essentially, right? Like, the revenue growth is just not there, so you could argue the valuation is overvalued. However, I am arguing that there is a problem with the Morgan Stanley downgrade, and that problem needs to be universalized across the entire market if we're going to make the argument that Palantir is this massive 50% overvalued company that deserves to be in the single digits because of their AIP product not generating revenue. And so this is my response. I don't think any stock on the market outside of NVIDIA has truly justified their AI premium. If you think about it, all these Magnificent Seven companies have gotten an AI premium of some sorts, but they haven't really showed it in their revenue. Microsoft went up $80 billion in market cap last month, if you guys remember, with plans around introducing AI-enabled Office Suite Copilot subscriptions. There's about 400 million people across the world that use the Office Suite, Office 360, Excel, PowerPoint, etc. Microsoft says, hey, for $30 more a month, you can have an AI version of all that stuff. The stock went up $80 billion in market cap because, the market was like, well, if only 10% of those 400 million people buy this, like what this does to the bottom line, it adds billions of revenue in top line growth. And so the market gave it a huge premium. That's when I think Microsoft went up to like $365. However, there was no AI revenue growth in their earnings that they reported. The potential of that revenue growth grew the stock. Although the stock has come down, I think it's at 330 right now, it's still up significantly on the backs of AI eventually leading to revenue growth. Palantir fell from $20 to $13 over the month due to worsening macro and lackluster earnings. But to argue that the stock deserves to slash 50% from here because AI revenue growth isn't in the numbers yet, which is the entire point of the report, then, well, every AI stock would need some type of correction besides the only one that has proved it, which is NVIDIA. And so that's kind of my core response to this entire report. It's like, if your argument is Palantir is overvalued by 50% because the AI revenue growth isn't there, well, yeah, the AI revenue growth isn't there, but the entire point of why the market is excited about AI companies is because if you do the due diligence, which Morgan Stanley obviously has done, AI is a real thing. It's actually happening. And NVIDIA earnings proved it. I mean, like, I don't even feel like I have to justify it anymore in terms of what's going to happen over the next 10 years when it comes to AI enterprise spend, because NVIDIA's GPU demand justifies enterprises paying for the models that they need to be trained on those GPUs. If NVIDIA demand was down, then sure, maybe there's a hole in the thesis around AI enterprise spend over the next 10 years. And maybe there can be more holes in the future. But as of now, the numbers are proving, like hard numbers are proving that this is a real thesis. But that's not going to happen overnight. That's not going to happen in the next, I mean, ChatGPT came out in March. That, like, the revenue growth of Microsoft, Google, all this exponential gains they expect because of AI fundamentally transforming the paradigm of how they even think about revenue acceleration, that's not happening in a couple of months. So I am not saying that the growth of Palantir is incredible. In fact, I'm saying it's not the best. I'm saying as an investor, you are taking a bet that there will be growth because of everything we are seeing in their ability to implement AI into the enterprise, even if it hasn't resulted in revenue growth. And so what have we seen over the past couple months? 400 customers in the pipeline for AIP in 10 weeks of launching. Unprecedented demand validated via management's comments on inbound calls and equity analyst Dan Ives talking about Palantir is the first company people tell him about when they're implementing LLMs. And obviously, if you've got 400 customers in the pipeline to potentially use AIP, then that demand seems to be substantiated. An AIP conference showing clients utilizing the product with a second conference just weeks away on September 14th. Palantir being the first known public company with a product announcement around something like AIP. Snowflake was second with their Neva acquisition, but we haven't even heard much of that in their latest earnings in terms of a tangible product. And now Microsoft has come out with ChatGPT for Enterprise, but this is months after AIP rolled out. On top of that, going for market share matters more than milking revenue out of customers 10 weeks into launching a new product. And that right there is my biggest argument at the end of the day. Morgan Stanley's argument against Palantir is there's no AIP revenue growth. So if there's no AIP revenue growth, the stock can't be priced like there's going to be AIP revenue growth. My argument is that they should grow as little as possible on revenue as long as they gain customer count, because that customer count, if we believe in the product, which is AIP, which as of my due diligence, I have, will translate into revenue growth. What will the pricing strategy of that be? I don't know. Will it be monumental? Will it be small? Will it be incremental? Will it be, different for BP than it is for a company like Lilium? I have no clue. What I do have faith in is Palantir's ability to be able to figure that out, and for the product to be so transformational and so useful for an organization that Palantir will have the pricing power. What I don't expect is for them to try to milk revenue 10 weeks into launching AIP and trying to be like, hey, texting them every day like they're a guy that is chasing after some girl. Hey, like, did you like it yet? Hey, can I get your number? Hey, like, well, what's the revenue growth? Like, hey, can we get some revenue? Are you ready to pay us? Like, no, that's ridiculous. Give it to a client for 12 months. Let them use the damn thing. Let it be infiltrated into their whole organization, and then they're like, yeah, this works. Like, how much do you want for it? And then Palantir's like, hey, how about $6 million? They're like, we could pay $3 million, but like, how about $4 billion? All right, 4. And let that process happen, because Palantir actually shows the value of the product, which is what they did with Foundry, by the way. And so that's kind of what I think they're doing, and that's why the Morgan Stanley report, and Morgan Stanley knows this, it makes no sense. This entire argument Morgan Stanley has, like, there's no revenue growth. It's like, okay, downgrade every single stock then if there's no AI revenue growth, if that's your argument. This report felt more like an end of August hit piece to grab cheaper shares rather than a true bear thesis, because a larger bear case would be that AIP revenue growth is not coming. That's not what Morgan Stanley thinks. They think it's coming, just not yet. And if that's the case, then as an investor, you have to ask yourself what price you are willing to pay for that future growth, especially if you believe that growth will be explosive. I don't know if $14 is the price you want to pay. I don't know if it's 15. I don't know if it's 16. I don't know if it's 13, 12, 17. I don't know what that price is for you. But I do know that if it's $9 for that future growth, I would happily pay that. I'm not happily paying 16 or 17 personally. I think that's a little bit rich. But if it ends up going to $9, if Morgan Stanley is increasing their position by 56% and they're putting out these hit pieces on one of their largest positions, I mean, remember, Morgan Stanley owns 17.9 million shares. So when they put out a report where the stock drops 10%, their 17 million shares and the overall value of it drops 10% as well. And that's, that sucks. But if you're in it for a long time, if you're in it for the actual real growth that's going to happen over the next 4, 5, 10 years, then you end up buying that dip. And I think that's exactly what Morgan Stanley is probably doing here, or that's at least what I believe their intention is to do here. So overall, I think Mariana's Bank of America report, which I did a video about a couple of days ago, is more logical. Mariana has an $18 price target and all of her numbers make sense, but those numbers are contingent upon AIP actually being monetized. If AIP is monetized and it's monetized in a way that makes sense and that increases the average revenue per customer and that growth actually accelerates over the next 4 or 5 years, then I think her argument is qualitatively and quantitatively making more sense around giving them an AI premium, because she's actually giving some leverage to this idea that Palantir is one of the only companies in the world that can securitize and properly implement LLMs into an organization. Morgan Stanley seems to understand that thesis. Their argument is just like, well, it's not in the stock, it's not like on the earnings yet, so we can't give it a premium. And it's like, okay, but in growth companies, you're betting on them being able to figure that out. Otherwise, you would never invest in a company that's not profitable, right? You're betting that eventually they'll get profitable. Eventually, everything will turn out fine with the numbers, but I want to be here early. I mean, that's the whole reason to invest in a startup, right? The whole idea is like, they'll figure it out eventually, but I want to be early before it gets there. In terms of valuation, I could argue that at $16, $17, Palantir is definitely overvalued given the lack of revenue growth. However, to say it deserves to go back to $9, which, like, yeah, it could happen. But to say that has to happen based on the fact that the revenue growth from AIP is not there and that the company deserves zero premium for having some level of an AI product that has been first to the market in the past 10 weeks and has 400 customers using it, it's hard for me to justify that. And so if you do it that way, you got to say every other company in the stock market that has not shown their earnings growth, like Google or Microsoft, via AI, they're doing great at their core business. Google's doing $72 billion a year, 95% of it off ads. That's great, but that's not AI fundamentally transforming your business yet, even if AI is helping you recommend the ads better. We're talking about real revenue growth due to AI for some of these big tech companies that have gotten some premium in the stock market because that's what the market expects will happen. That would have to be taken away if Morgan Stanley's logic applied to all these stocks. And just because I don't think that's the best logic, that's why I don't think this report is the best. And that's it. Those are my thoughts. So overall, I agree more with Mariana, but I understand where Morgan Stanley is coming from a numerical perspective. Don't understand going back to $9 and giving zero AI premium just because the AI revenue growth is not there yet. That's it for me. Thank you guys so much for listening, watching. I hope you guys enjoyed it. Hopefully you got something out of my breakdown of this report. If you want the report, DM me on Twitter @AdamItIsInvesting, and I'll send you the entire report via email. What should we end off today's video? What thing do you need to leave in the comments to end off the video if you made it this far? By the way, I appreciate everyone who leaves a comment like water bottle or microphone or whatever I say at the end. It's so awesome that you made it to the end and you got to that point. It's a special thing that a few of us have in common, because I got to the end because I made the video. You got to the end because you watched the video. What should we do? What's a cool object? Here we go. I'm on the spot. I already used blue pen. I can't use blue pen again. We're gonna use briefcase. It's probably the most random thing you've seen, but briefcase. Use it in a sentence somehow. I'll see you in the next one.